Hello, viewers. Welcome to the seventh episode of Lootbox TV. I'm Manish, and this is my co-host Tanish. We have with us Mr. Diganth Jagadish. He's the founder of Incentiv. So before we begin, sir, we can explain basically what Incentiv is and what it does.
Sure, right. So, incentive as a single line, we're building the infrastructure for private equity, right? And how we aim to do that is by solving various different problems that exist in the private equity VCP ecosystem today. And the biggest elephant in the room, the biggest problem, of course, is the end of the life cycle, that is liquidity. So, liquidity is the main big problem that we're trying to solve. If you own shares, if you own ESOPs, if you own any kind of securities in a private company, exits and being able to sell and make money out of that is the problem we're trying to solve through a platform of us. And the whole infrastructure piece is essentially where through that platform and the allied different products and services that we have created, we solve for various other things that come way before liquidity event ever comes, like managing your cap table, managing your equity, managing your fund if you're a VC or a P or a family office, getting our equity issuances in place. So we have a consulting arm for various different services. We have a SaaS, software as a service arm, for companies to manage their equity and the cap table, as well as for VCs to manage their entire fund. And then we have a platform to solve for liquidity. So we think about it as solving for the biggest problem and then go backward integrating into the value chain of equity right from issuance, right? So that's essentially what Incentive does. We're about 4 years old, based out of Bangalore. We have an office in Bombay. Small team, lean and mean is how we'd like to call it. But yeah, that's about it.
So I think you just mentioned a lot of terms and a lot of activities that incentive does. So we just wanted to break it down going forward. So while we start with ESOPs, can you let the viewers know basically what an ESOP is?
Sure, right. I mean, in our business, where ESOP is very comes into the picture is where we help companies issue ESOPs, manage ESOPs, or help ESOPs take an exit. But what is ESOP fundamentally? ESOP is essentially an instrument, basically a contract that you give to employees, saying, "Hey, I'm going to give you a certain amount of stock options, basically a unit, which can each unit can give you a right to own one share or multiple shares depending on a ratio. But you're not going to get that today. You're going to get it over time, right? If I give you 100 units of 100 stock options, that will unlock over time a time which is called as vesting schedule, which can be 1 year, 2 years, 3 years, 4 years. So if you stay in the company for long enough time, all of these units are going to get unlocked, and eventually they can turn into shares. Say someone tells you, I'm going to give you 2 lakh rupees of stock options. You don't actually own 2 lakh rupees worth of shares. You have 2 lakh rupees worth of right to own shares, right? Just a right to own shares. That right will unlock over 1 year, 2 year, 3 year, 4 years, depending on whatever agreement you have with the company. For that, sometimes you might have to hit revenue milestones, you might have to hit performance milestones, or you might just have to stay in the company and not leave the company for a long enough time. Fundamentally, that's what stock options are.
So, sir, you mentioned that you deal in the secondaries market. So, does it help in the buying and selling of ESOPs? If yes, why do VCs don't want a lot of ESOPs on the cap table?
See, I'll take the second part of it. So ESOPs or stock options don't directly sit on anybody's cap table because they're not shares yet. A cap table is just a list of folks who have shares in the company. That's it. It's just a table of just people and how much they own in the company, etc. Stock options don't sit anywhere. See, basically, stock options is so you have a full, authorized share capital, which is the total number of shares that you can issue, but a part of that would be issued and allotted. So 10, let's say 1 lakh is authorized, but 10,000 are issued and held by people. What you do when you create a stock option pool is you reserve a portion of the authorized share capital, maybe 1,000, 2,000, 3,000 shares. They are not created yet. They're not been issued to anybody. They're not been sent to anybody. They're just reserved. So only when a stock option is exercised, one share from that or two shares from that will be taken, be transferred to an employee. So till then, neither the ESOP pool nor anything sits on the cap table on a undiluted format. Okay. Now, what we help in secondaries is employees who have vested stock options, because if it is unvested, that right has not come to you itself. Like I told you, right? ESOP is a right to own shares, but that right will unlock over time. Right? If that right has not unlocked, you can't sell it. So if you have vested stock options where that right has been unlocked, you can do two things. One, you can exercise it, pay the company money, the taxes, and all of that, and get shares in return for it. Or second, you can look at potentially getting a buyer who will buy that out. It's a longer process to get a buyer who can buy that out because you can't directly transfer ESOPs to someone. You have to still turn that into shares and then transfer shares. So if Manish wants to sell, let's say, 5 lakh rupees worth of ESOPs to Tanish, he can't just be like, hey, here's my ESOP letter, I'll forward it to you on email. From tomorrow it is yours. Just, we have that agreement, you give me money. That doesn't work. Money still has to go to the company, turn that into shares, become a shareholder, have those share certificates either in physical or demat form, and then go through the long process of getting the right of first refusal, getting Tanish's offer to purchase in a proper format, getting the share purchase agreement, share transfer agreement, all of that done, and then transfer.
Mm.
Only all these things have to be done for that sale to happen. So even with secondaries, what happens is, let's say a lot of employees come to us, a lot of companies come to us, management, they come to us saying, hey, there's so much stock options, so many employees, we want to give them an exit, or employees themselves saying, hey, I want to take an exit. In all those processes, you can't, again, like I mentioned to you, right? You can never sell stock options. You can sell the shares that the stock option will become one day. But for you to convert stock options into shares, you've got to pay a lot of tax. So even if I come to
Mm.
you and tell you, hey, give me 10 lakh rupees worth of your stock option, but convert into shares and give me. If I now, what you have to do is you have to go to the company, you're going to pay the exercise price. There's a large tax you'll have to pay on 10 lakh rupees. Maybe your exercise price might be very little. So the FMB, fair market value, will be very high. So you'll be paying a large amount of taxes based on a tax slab. You're going to come to me and be like, okay, but what if tomorrow you just run away? I would have just paid all that tax amount and sitting on shares. And you can back out at any time, right? So how can I take these risks? So that is the biggest issue with people buying ESOP. There's a risk factor because the employer has to exercise first. So that's where Incentiv comes
Mm.
into the picture. And we have built the rails around managing risk, around having the right kind of intent, having the collection system for the money, so that that risk is alleviated. And then we work with management itself to ensure ways to, one, do cashless exercises if the management is willing to sort of take the cash and figure out how exercising and deduction and share transfers can be done automatically. The management can do it. Every management can, but it's a slightly longer process. They do that. Else, we have the right kind of systems in place where the employee who wants to sell his stock options, which will become shares, already knows that the buyer is not going to back out and all that. So we have sort of, in a very trust deficit sort of a transaction, we have added the trust layer, making it possible for employees to even think that, okay, if I want to sell stock options, I can do it through these people,
Who are the
as
buyers
opposed to
in
doing
this
it.
market? Sorry to interrupt. Who are the
See,
buyers in this market?
the buyers can be individuals, buyers can be family offices, buyers can be funds, buyers can be other kind of institutions which essentially are structured like funds or prop books, etc. Right? But there's a specific amount of network. So because we work on slightly larger ticket sizes, we don't work with retail, or we don't work with even baseline HNIs as well, because the ticket size is quite large. And for you to have even that much allocation into a private company, you need to have a sizable portfolio, right? Overall portfolio. So individuals, family offices, funds, a lot of these days, what's happening? A lot of secondaries and growth stage opportunity funds are being, set up because there's so much bottleneck and there's so much equity, then pent up supply. There are a lot of funds being set up for these purposes to be able to invest and participate in these kind of transactions, which would otherwise not be possible, right? So all of these people are our customers. And depending on the ticket size, the right kind of buyer steps up.
So you help the employees find the buyers, or is there already a buyer in place?
It could be either, right? And some other versions of it. When we work with companies, and these are good companies, not every company is a candidate for a secondary transaction. If it's too early, if it's too performance wise not been doing really well, the odds of the secondaries happening for such transactions is going to be slightly lesser, because purely because of the fundamental issues of the company, right? But let's say the fundamentals are in the clear, the management of the company is willing to allow the employees to sell, because sometimes management might not allow as well, right? So if all those checks are there,
Mhm.
on a platform is a matchmaking platform, looking at the size, looking at the scale, looking at the sector, looking at the deal flow, the size of the deal, the lot size, and all of that. it gets mapped to the right people based on their intent. Very little work to be done by my team. The platform takes care of finding the right buyer. If the right buyer doesn't exist, then our team takes care of finding the right person, right? So sometimes what will happen is, let's say you were to sell equity in, let's say, an NBFC of sorts, and you own stock options there or shares there. And there's always already been some pent up demand on the platform for that specific sector, or maybe even in that same company. Then the mapping gets even easier, right? So it's all of the heavy lifting work of matchmaking and finding the right person to buy your equity done by the platform, right?
Got it. So, is it basically a private market transaction? The ESOP buying in the secondaries?
Yeah, I mean, it is a private company, right? So it is a private market
Mhm.
transaction itself. It's a very private,
So,
and
yeah.
underscoring the word private, right? It's very very private. None of the deals that we do ever come out. Now we don't advertise. These are very, these happen the way these kind of transactions are supposed to happen, with the buyer and the seller being the only few parties privy to the transaction, because they don't want to publicize that, hey, I bought this large lot in this company, or sold in this company, etc.
So, so how do you see in the future the landscape between private market transaction and public market transaction changing? Like, do you see more of private market investment going in?
Two things are going to happen. Firstly, the number of companies that are still private as opposed to the number of companies that are in the public market, that is going to have to change, because there's very few companies that have gone public in India, right? Especially barring the legacy, uh, old school kind of industrialist businesses, very few new age companies have gone public. And but if you look at the number of
Mhm.
companies that are there, in number of private companies, even DPID registered companies, over a lakh and a half. Many of them will shut down, many of them have shut down, but there are more than a lakh companies that are operating today. Good portion of them are doing well. Many of them will go public in the near future. And the more accessible public markets get, the better it will be for the entire ecosystem. On the private transaction and the private market side, again, Indian private markets are very, very new. Right, there have been some funds who've been operating in the 90s, some funds who have been operating in the 2000s. Very scarce, very boutique, very niche. But from a very industry landscape standpoint, or from a holistic standpoint, investments in private companies is a very new concept that probably exploded after the mid to late 2000s and early 2010s is when it really picked up. By the middle of 2010s is when it started ramping up significantly after Flipkart, and few companies did well back then, right? So many of those early stage funds, they'll just come to their end of the life cycle of 8 years, sometimes 8 plus 2 years, recently in 2024, 2025. So
Mhm.
we have seen the first generation of VC funds hit their cycle only last year. It's that new, right?
Okay.
So it is extremely new. The end life cycle, the end transaction part of it, and the secondary transaction part is starting now, right? So till now, it's all
Mhm.
been private capital deployments, primary deployments, right? For the last 10, 12 years, the real secondaries is really starting now, because till now the pent up supply was not unlocking. The largest amount of supply is with the largest private shareholders, barring the promoters, which are investors and VCs, right? And that's unlocking right now. So in the next 5 years, imagine, because between 2015 to 2020, especially 2020, 2021, of course, there were a lot of duds and a lot of bubble territory investments, but the amount of capital that was deployed was insane. And all of that is going to now unlock at a much, of course, a much larger size than the actual deployments happened. And where is all that supply going to go? Some of it's going to get public. Investors are going to ask the companies to go public and give them an offer for sale so that they can exit. But a lot of them is going to be in the private market. Really good companies that have to be serviced well through secondary transactions, and that's where we're at the intersection of that right now.
What is a condition in where, what are circumstances in where a company or set of employees asked to go to the secondary market or believe that they can get a good value unlocking from the secondaries?
Firstly, the most common, the most common reasons why any investor or an employee asks for a secondary exit is because they've been sitting on the asset for a very long time, right? For example, uh, eventually, if you think about from an employee's perspective, right? An employee joins a company, let's say very early on, goes through all the hustle periods of, of uncertainty and late nights and a lot of work and low pay in the initial years and all of that. Stays for the equity, stays for the ESOP, stays even longer, does more work and all of that. Has seen their salaries grow, but hasn't seen life changing wealth, while the company's valuation has grown really high. At about year five or something, they will ask the founders, right? Hey, listen, like, can somebody buy my ESOPs, or can we do some buyback? If not, can we do some secondaries? And that is what has happened in most of the cases that we have seen. These folks have stayed there for 5, 6, 7 years in some cases as well, and I've got barely anything in the form of actual equity returns. I've got good salaries, all that is great, but his salaries are not life changing money, right? One stock option sale can offset 5 to 10 years worth of your salary. Like, it's that big, right? So it really unlocks a different level in your life. So that's why they come, because how much longer can they wait? The risk has, it's taken 10 years of 7 years of their life, right? Now, how will they get that money to reward them for it and make new changes? Maybe they might want to start their own company. Maybe they might want to retire. I don't know what their needs are. But whatever it is, this should fuel that. Same thing with investors. A lot of investors, angel investors, friends and family would have invested at very early stages of seed, when there was not even a single line of code written, or no real business plan, or no MVP as well in many cases. And they ride the whole wave, and they ride through dilutions, they ride through new investors coming with getting better preferential treatment and all of that. They sit through all of that, and they at some point also want their return. They want that capital, returned back to them, right, so that they can redeploy it somewhere. And they come, and they're like, hey, I want an exit. And then the founder is by then very busy in doing their own work and their own business. They can't go out to the world and find a buyer for these investors or these employees, so they come to us, right? So time and patience and actual reward not getting unlocked is what drives people towards secondaries. And it's not even secondaries, it's what drives people towards liquidity, right?
Mhm.
Whether it's secondaries, buyback, or whatever it is, it drives people towards liquidity, because at the end of the day, you want money back. Money, cash is king when it comes to anything, any asset. You put money in mutual funds, if it's just going to thin air, you would never put it. At the end of the day, when you need that money to buy something, to spend on something, you need to be able to liquidate that. If that is not possible, then that asset is not really a great asset.
How liquid do you think is the VC space currently?
It's very illiquid, right? So if you look at just the other day, I was looking at a chart. So the amount of capital that has been invested, right, and the amount of capital that has been sort of distributed back, it's less than 50%. So on a yearly basis, cumulatively, the amount of deployments has always been more than the amount of returns, and that has been happening over time, the last 10 years. So when is the money cash returned back to the investor ever going to catch up or even make up for it? Because if you're always trailing deployments, then when are you actually making money, right? Because because for an investor, see, for an investor where the money is being managed by a money manager like a VCs are money managers, right? What they basically want is, I'm going to give you cash, you're going to play with that cash for maybe 5 to 6 years, because the first 3 years are going to be scouting and all of that. Then you're going to invest hard for the next 3 or 4 years. In the last 2, 3 years, you're going to let it sit and grow. So that's how it happens. There are cycles, right? Deployment cycles are usually 4 years, and then you're going to wait, let it simmer for about 3, 4 years. It has to be returned after some point. So that is not happening. So
Mhm.
it is very liquid. It has been very liquid. The acquisitions in India is very little. The amount of companies that have, like I told you, gone public is very little. So most of the capital that has been deployed has either been completely written off because companies shut down, or is sitting on a paper asset somewhere waiting to be dispersed back.
So do you think secondaries is gonna create up liquidity in the venture capital space too?
Yes, yes. Secondaries is going to create massive liquidity in secondaries. So in venture capital and private equity, because going public should not be the only option always. Like, what many people don't understand is, although going public is a great achievement and all of that, when you go public, you have a completely new set of challenges that you've got to, barring compliance and SEBI norms and all of that. You are answerable to the public. Every major decision requires voting from everybody and all that. So there's a lot of scrutiny, a lot of like a lot of things you can't do, right? A lot of things you
Mhm.
can't do. So a lot of freedom gets stripped away from you. So a lot of founders, in many cases, don't actually want to take their company public, but don't have an option to take it because they have to give liquidity to a lot of their shareholders, right? Um, Many companies would thrive being private rather than being public, right? So many companies, once they go public, a lot of decisions cannot be taken. But they need approval for everything in many cases, right? Um, so giving liquidity or giving a new way or new brand of potential liquidity as an option is very essential for the private equity space and the VC space, right? Because buybacks
Yeah.
require a lot of cash that the company has to now cough up to buy it back and cancel the shares. IPO again has its own challenges. Not every company might want to go public. It might not be in the best interest of the company. So, what is the cleanest way where the company's cash reserves are not touched, nor is it forced to go public? Secondaries. Like you
So,
basically pass on your risk to another investor who's willing to take that calculated risk based on where the company is today.
good. So is secondaries becoming a maybe stock market for a primary market, a private market, sorry.
No, no, secondaries is not a stock market of any kind. Like I mentioned to you, right? Even our business in secondaries, we uh, we don't operate like a marketplace. We don't operate like an exchange or anything. All our transactions happen in a very secure, very protected, very um private manner. There's no charts, there's no tables, none of that. There's only potential offers that you can express intent, and then you go deeper into the rabbit hole of the transaction.
Okay. So
So,
how does a UHNI person sitting in, let's say, tier two, tier three city of India get aware of these transactions? Because even if there's a, let's say, UHNI person sitting in Lucknow or, let's say, Bhubaneswar, maybe Guwahati, they're not aware of secondaries market or the transactions that take place here because they're not privy to such knowledge. Uh, what can they do to be connected in this space and then take place in the transactions that take here?
so a couple of things. I think the first thing, what can be done to help them? That's more of an education and an awareness thing, right? So that is missing. And it's okay because it's a very new concept. If private equity in India itself, not private equity, the VC and venture space itself is a new concept. Secondaries is still an infant, right? It's just being born right now. That's how new it is. So it is okay if they don't get it, if they don't understand. It will take a while for that education and that awareness to be passed. And through these conversations, like the one we are having, is where that awareness spreads, right? Second is, of course, if they work with the really good wealth managers, uh, they will be exposed to secondaries and the private equity, class of assets as well, right? And within the PE asset class, the private ownership asset classes, secondaries is one of the ways to get access to it, right? A lot of family offices, a lot of UHNIs today, when if they're working with a manager who's managing their funds, right, a wealth manager, or even an investment advisor in the private. So there are specific investment advisor who can offer these kind of advice. They are advised to invest or allocate a small portion into private companies as either angel investors or LPs in funds, etc. And secondaries is how is another way of entering that they will sort of find out when they start exploring it, right? So a lot of education, a lot of awareness, and a lot of work that managers, wealth managers, have to do with respect to pushing the narrative of investing in private companies. But of course, because it's so new and the risk is so high and it's such a new asset class, a lot of people don't understand it. Like us, we understand it, but many people don't understand anything that they can't see on a charts moving every day. They don't understand something that they can't just sell, because apart from even homes and land, you can still sell it as illiquid as it is. You can still sell it, but a share in a private company, it's not that easy to sell, right? So many investors, many people don't understand that concept that, hey, I'm putting my money in this company, I'm not getting returns every month, I can't see what the valuation changes on a daily basis, and I can't sell it whenever I want. So many people stay away from it because it'll take time for that education to be imparted in terms of what is the asset class and why is it like the way it is, and what is the growth story that you can sort of be a part of. and how to make sure your allocation is right, how to make sure your assessment is right, your due diligence is correct. So all of those will take a little bit of time, but it's happening now. It's happening very fast. A lot of family offices and a lot of individuals are increasing their allocation to private companies as we speak. In investing in private companies, it used to be bonds and golds and real estate before, and a little bit of public markets. But now it is changing with more allocation towards private companies as well, because they've seen in the last 5 years the kind of growth stories that have come out through Zerodhas and Razor Pays and all of that, right? So they've seen a lot of this happen, and with more private companies that will be listed in the public markets, which they are very much active participants of, they will want to be a part of the private companies more and more, because they'll want to be a part of the private company journey before it goes public. So
Wow.
where the actual value and wealth generation opportunities are, they'll want to be a part of that as well. So it's happening. It's happening fast, but it'll take time.
So in a previous conversation, we remember talking that you also serve Nikhil Kamat's family office. So how did that come about to you, and how you are helping such big family offices?
So we are, we work with all kinds of family offices and all kinds of individual investors. Not to name any names, right? So we work with over 240, 250 family offices and VC firms, etc., across the spectrum. It's not necessarily and not necessarily in India as well, right? And overseas. And how we work is, it could be through secondaries, it could be through a fund management tool, it could be through something else, right? There could be buyers in our secondaries, there could be sellers, and we might have buyers. There could be using one of the tools. So, and across the spectrum, we are, because I told you we're building an infrastructure for private equity offering, and we have many things. So at this point, Incentive is known as the secondaries platform. So any investor, when they think about secondaries, usually Incentive is also part of that conversation, part of that flow of thought. And that's how we've been working with many investors who either have investments in company or are looking to enter into specific companies, etc., where we become that intersection, we become that layer that allows them to either offload or get on, right? A specific ship. And so, yeah, so name it the kind of industrialist promoters, name it the kind of publicly listed company promoters. Most of their family offices are a part of our, platform or our network that we work with actively. We work with most of the tier one, tier two, tier three funds in India as well, which have sizable portfolios. Most of the secondaries funds in India as well, we work with them. And now we've started working with a lot of individual investors, individually recognized as well. So yeah, and as the as the business keeps growing, it'll just more and more people will sort of come as inbounds.
So, how do you think a general partner in a VC fund uses secondaries to his advantage?
So what is happening right now is a lot of GP-led secondaries are happening. Basically, GP-led secondaries where the fund itself will come to us and be like, hey, I want to, like I told you, right? 2015, 2016, that vintage funds are essentially coming to an end. They can do two things. They can keep extending the fund, but at 10 years, you can't extend anymore. They can start another fund, have some of the LPs on this. There's specific math around how much you can and how much you can't in terms of overlap. Get new LPs to invest in that new fund and buy the equity from and the holdings on this fund and continue that fund and do all of that. It's called continuation funds, right? So really good companies that they don't want to sell, they do that. Now the companies that they're okay, selling the stake, and now they want to close this current fund and raise a much larger fund. So they want to show the new LPs that, hey, this entire fund has been a success story. This is the IRR, this is MOIC, this is what we've got, how much we've returned on the terminal value and all of that in terms of realized gains. They'll want to offload the entire fund and show that, pop the champagne. That is where secondaries becomes a big picture, because secondaries is something you can do with urgency as well. What I mean is, you can't force a company to do a buyback if you need an exit. Let's say your fund is coming to a close next month. You can't go and force the company to do a buyback. They'll be like, dude, I'm not doing it. I don't have the money. You can't force them to go public either. DRHP is a very long process. You might get rejected. SEBI might tell you to do 5 other things, and then you do it for 3 months later, there'll be like 5 more things. That's why we've seen, right, after DRS being filed, it takes a couple of years as well, because SEBI doesn't allow you to go on the main board that easy. So then the option of fulfilling your requirement for liquidity with that urgency is secondaries, because you don't have to wait for SEBI's nod, you don't have to wait for the company to cough up capital. You just need somebody who understands the company whose equity you own, understands the risk that they're getting into, has done the assessment of where the company stands, believes in the growth story from that day forward till when they get an exit, and are willing to ride that ship. When you are getting off, they're willing to take your seat there. That is possible in secondaries. So GPs are understanding that secondaries are the only great option, the only real option where urgency can also be satisfied. That's why they're doing it. Now, another is what LPs are also putting pressure. Even if a GP wants to do a continuation fund or it's coming close, let's say a fund is 5-6 years, hasn't returned a single rupee, all the capital has just been deployed. LPs will now start getting a little, shaky. There are other LP friends who are part of other funds and have invested with other managers. They are getting their money back through one exit, through one acquisition, through one Series C, a secondaries happen, etc. But this guy has not really returned much, but on paper they're showing crazy IRR and all of that. This LP is going to be like, man, I need some of my capital, figure it out, give me some of my capital back. So LPs will sort of rally and want to take exit. So it becomes LP-led secondaries. LPs, sometimes what LPs also want to do is they want to get out of the fund and get another LP, and so they'll just sell all their NAV units of that fund, and it's a slightly more complex transaction, but that also happens. So secondaries can happen through by GP's own volition or by LP sort of putting pressure. But second, like I mentioned to you, IPO very long. SEBI might take whatever sweet time of its buyback. You have to force the company to use its capital. It might not. Secondaries is the only logical, option.
Okay, so you have been a startup founder and you recently completed your fundraise round. What has been your journey like, and one advice for someone who is operating in such a niche space and trying to raise funds?
Yeah, I think. I mean, this is not my first company, so I've had my own businesses before as well. Although not in the same industry and not as a proper company with a large team, etc. But you know, advice is essentially to find signals very early, and so once you validate your signals, so we validated the need for liquidity and need for exits for by speaking to ESOP holders and employees early on. Right, when we used to go to conferences, just me and my co-founder, we'd meet a bunch of people during the lunch and coffee and all that, where everyone interacts, and we just tell them, hey, this is our idea, what do you think? And everyone would be like, yeah, no man, I have equity, I have ESOPs, it's a good thing, nobody's solving and all that. So getting some initial validation to see if there's some fuel to that, to be added to that fire is required, and then you got to really test that very fast. And once you do that, if it's a very niche, a very difficult, or a very high hanging fruit sort of an idea like ours, it takes many iterations, and it takes form that other people have not seen before for the actual solution to come. What I mean is, so in our industry, in what we are solving, there have been incumbents, people who have been there before us, who are veterans of the industry, been there for 20, 30 years into private equity. There were VCs who started that, and they wanted to solve secondaries and liquidity, and they couldn't solve. So then anybody's logical answer would be, y'all are outsiders, y'all are not even from the VC space. How can you folks do what they couldn't, right? Their experience is more than your age. How can you do something they couldn't, right? So it requires you to stay put and try solutions, where you look at various different problem statements and try keeping solving that. And what solution you get is going to be a very left field solution. It's not going to be something that someone who's been in the industry for a very long time will be able to solve, because they're going to think through their first principles based on their experience. But you are going to bring something from a very outsider's perspective. You might do a little bit of jugaad, you might do a little bit of that and this, and then eventually lead into a very sophisticated solution, which will be the one that solves the problem, right? So, generic sort of a statement that I'm going to give is like, just stay put. But while you're staying put at that, solution, right, make sure your problem statement is being validated, right? One, and make sure that it is not, doesn't have 10,000 people doing the same thing that you're doing. Because what happens if the problem is so commoditized that everyone is solving it, your product becomes a commodity. If the problem is very hard that very few people are solving it, your solution can't become a commodity very easily.
Do you also think secondaries coming in will lead to a price discovery or a transparency in the private market?
Partly. See, so secondaries transactions actually, they're great for price discovery, right? They're great for understanding what another investor values it, but they are not perfect for price discovery, because what is not taken into consideration during a secondary transaction is that usually is what share class is being sold, right? For example, when you're doing a
Mhm.
primary fundraise, you might be giving CCPS, right? So it might have a lot of preferential rights. It might have anti-dilution clauses, might have board visibility, observability, or a seat, or a voting right, or any bunch of things, right? A lot of rights that a common share might not have. So usually during secondaries, what happens is if a common share is being sold and not a preference share with all these rights, or even if a preference share is being sold with some of those rights being removed, which were part of the previous round, there will be some sort of a discount. Now you can't look at that discount and be like, hey, this is now discounted. The valuation has to be discounted. It doesn't work like that. Firstly, what kind of share class is being sold with what kind of rights? Peg that to the previous round. Are they a perfect match? If not, the previous round was validated and was valued at those preferential rights that were given to those shareholders. So this is going to be slightly different. Second, who is the seller and what is the reason? First, for example, if an employee or let's say a shareholder really wants capital right now, let's say he has a big real estate project coming and needs about 20 crores and wants that money, he's like, no, it's okay. I made money on this company and needs that capital, put it here to build my next large project. He might be willing to take a 40% haircut on the share as well, or a 50% haircut. He's like, it's okay. I made 7x. It's okay if I take 40%. I'm okay with 3.5x as well. All right. Now that doesn't
Mhm.
validate, or that doesn't become a new signal that the company's valuation is that much. For example, if someone sells their house at a distress sale, that doesn't normalize or bring down the entire real estate value of that area, right? Like in someone's
Yeah.
apartment, if someone sells it at 40 lakhs, a 1 crore apartment, it doesn't, all the other apartments will not be sold at 40. What is the reason? I don't know what circumstances.
But it does give leverage
It
now
does give leverage. It does give
for
leverage.
the other sellers or the
It
other
does give leverage.
buyers.
And that is precisely when
Now they can negotiate the prices to the earlier transaction level.
yes. On a secondaries transaction, it does give leverage, but again, context is important. If the same share class is being sold under the same circumstances by the same seller, maybe they can negotiate. But again, right, secondary transaction is a buyer meets a secondary seller midway, halfway, an approach. So if Tanish sells to me at let's say 40% because he needs to invest into his own business or whatever, and he's willing to take a little bit more discount to make sure it sells fast, and I bought it. But you, Manish, you don't want to. You want to take the same thing, 40%. But and you tell me because he sold, I'm also gonna buy it at the same price. Another seller might not want to sell it to you at the same price because he doesn't have the same issues, right? He might be like, no, it's okay. At 40%, I'll stick to it. I'll keep it. I'm not going to sell it. Doesn't matter. Maybe 2 years later, I'll sell it. So that is what happens. Although yes, in a conversation, someone can bring it up that got recently sold at whatever. It doesn't really hold a lot of weight because the context is missing. Like who was the seller? Why did he sell? Under what circumstances? Is it because the company's fundamental value, or is it because of their personal whatever and share class being sold? That is one. Second, when we do secondary transactions, usually those almost nobody knows that at what value and who sold and who bought and all of that. So we make sure it is very private. So one buyer will not know what the other buyer bought it as, purely because that is how we operate. We want to make sure that everybody's privacy is maintained.
Like, let's say in a fund, there is an investment concentrated in a company or in a private company. So, how is that picture gonna change after secondaries coming in? Is it
Oh
going to
yeah.
be the same?
So no, it is definitely going to help it, because what happens is one of the most important things that any investor, any VC has to do basically is to make sure that the capital being sort of deployed is managed is properly allocated. Asset allocation is very important. So if any company really grows a lot, whereby that company specific valuation is a large portion of the entire assets that the VC owns, right? The entire portfolio. If a large portion is concentrated with one company because that valuation grew, the risk is very high, right? And
Mm-hmm.
it doesn't now sit within the thesis of asset allocation of that VC, right? They need to have very strict key. This is the percentage with each sector. If they're sector agnostic, that is. If they're not sector agnostic, this is the maximum concentration risk we will take from each company and all of that. They need to have these things in place. Or if they invest in multiple rounds and multiple valuations and multiple kind of stage of the company, and each of them will have different risk profiles and all of that. So they need to they need to have a proper asset allocation. The moment it crosses that as a percentage, you should sell some of that to redeploy that and bring the concentration down, right?
Yeah.
So secondaries will help companies offload some of their best performing horses, right, and to be able to trim some of their holdings in those companies. And that is exactly how many funds use secondaries as well. If a few of their bets have done superb and now they're eating up a large portion and take a large seat in their portfolio, they try to trim it down so that either capital can be redeployed or given back to the to the LPs and taken, their carry on essentially.
Got
Okay, for a final question, any suggestion for someone who is doing a fundraise right now, since you are seeing the VC space very closely?
Yeah, so there has been like a little bit of a cycle recently. So a lot of VC money was into early stage companies, and then early stage became very risky. So they went to post Series A and Series B level bets only. Now it's coming back to slightly more early stage companies, etc. But what's happening and how the status quo has changed is those days of we will invest in you just because of you, just because of the founder and the founder's background and pitch deck and all that are gone, right? Today, a lot of investors are very cautious, primarily because when the amount of capital that is flowing into foreign portfolio money or anything which is flowing into the private markets is less, you have very little capital to deploy, very little capital available anyway. So you become very risk averse. In 2020, 2019, 2021, 2018, 2019, 2020, there's a lot of capital flowing into Indian private markets. There's a lot of funds were just starting like this and raising crazy amount of cash, and they're just giving out money. Now
Mm-hmm.
that's not happening. There's a fraction of that is entering into the private market in the form of investors' money, LPs, right? So it's very difficult for funds also to now raise through LPs, right? LPs are very cautious because the macro environment is not that stable right now. A lot of people have lost a lot of money in the public markets itself. So when their actual wealth has gone down because either their companies which are listed valuation has gone down or their own portfolio has gone down, they are not putting more capital into private markets. That's not happening. They're putting more into conservative. They want to conserve their assets. So less capital is flowing into private markets. Hence, VCs also have less capital to play with, right? So they're far more cautious. They're okay waiting a year or two and not deploying capital as well. They're fine if they don't do it fully. So raising is getting harder unless you have a strong, proof of concept and you have some user base. You are solving a problem. So due diligence is becoming far more stringent. I thought due diligence was stringent when we had raised money. It's getting even harder now.
Mm-hmm.
That what that means is on the other side what's happening is, as opposed to in 2021 and 2022, now there are far more people who are starting companies because of AI. What that is also
Okay.
doing is many people are starting companies in AI as wrappers and very basic forms of using AI and building very basic products, very commoditized. Get something on Cloud Code and build a static website and get something. That doesn't work, right? When building a company is commoditized, only those that are far head and shoulders above those commodities get funded. Everything else just becomes noise. It is going to get to a
Mm-hmm.
point where, because VCs on a daily basis, I'm sure you all also know, get so many pitch decks. After some point, the moment there are certain words in it, certain things in it, it just doesn't. No one is even going to check it, right? So it's a very hard time being a VC also today. It's a very hard time because you don't know which is a good deal, which is a bad deal, because there are so many potential deals, but about 99% of them are just going to be a kid who just started a product last Saturday and is now wanting to raise $100,000 on that.
Got it. Thank you so much, sir, for your valuable time, and thank you, viewers, for watching this episode. At last, sir, we would like you to tell our viewers to kindly subscribe our channel,
No, definitely subscribe to the channel. What is the channel called again?
uh, Flute Flute Box TV.
Okay, wonderful. All right, and this is going to go on YouTube, right? So you gotta like, comment, subscribe, share, and I'll be watching as well.
Great.